Hey everybody, welcome to Mortgage Today for Monday, December 11th, 2023, and oh, what a day it was. UMBS were down 13 basis points on the open, the 6.5 was down 19. Global equities posted modest moves at the start of the busy week of economic data and central bank meetings that will test optimism amongst investors that interest rates will soon head lower. In currencies, the yen extended its losses to 1% after Bloomberg News reported the Bank of Japan officials see little need to rush into scrapping the world's last negative interest rate, citing insufficient evidence of wage growth feeding inflation. Traders are looking ahead to U.S. inflation figures on Tuesday, the Federal Reserve policy decision on Wednesday, and retail sales numbers on Thursday. Policy decisions at the European Central Bank and Bank of England add to a crowded calendar. Friday's jobs report has a lot of people thinking about a soft landing once again. The labor market seems to be holding up despite aggressive tightening policy we all have seen over the last 6-8 months. Consumer spending appears to be slowing and credit is tightening. If these things more or less pause here, then we have achieved a soft landing. The big question is whether all of the fiscal stimulus from 2020 to 2022 just delayed the inevitable instead of preventing it. CPI will be released tomorrow morning, followed by the PPI Wednesday morning and the Fed decision Wednesday afternoon. The markets expect the Fed to maintain interest rates at current levels. The Fed will release its new round of economic projections and the dot plot. So a lot of attention will be focused on how many rate cuts the Fed sees next year. Nick Timaros, aka Nicky Leaks, that's the first I'd heard that, I kind of like that, is a reporter for the Wall Street Journal who is pretty plugged into the Fed's thinking, or they actually leak him stuff that they want to test. He wrote a piece over the weekend which discussed the reasons why the Fed might start cutting rates. The most benign scenario is that inflation continues to fall and interest rates at high levels, real interest rates continue to rise. In this scenario, the Fed would be cutting rates simply to maintain the restrictive level of rates. The other scenario is the hard landing scenario, which usually accompanies such an aggressive tightening policy. We are seeing problems with the consumer, at least if you listen to what the publicly traded retailers had to say about third quarter earnings. Credit is contracting as higher rates have drastically reduced the mark-to-market size of capital base of banks, so they can't lend as much. Housing has been a big driver of inflation over the past few years, and it looks like rental inflation is cooling, and some of the hot markets in 2020 to 2022 have seen some big retracements in pricing, especially in places like San Francisco, Austin, Las Vegas, and Phoenix. It's been quite a while since we've dusted off the PSR abbreviation, which is short for post-supply rally. The supply in question is a scheduled auction of U.S. Treasuries. At times in the past, merely getting through a set of Treasury auctions was often worth a sigh of relief, expressed in the form of additional bond buying. While that dynamic hasn't been as noticeable as it once was, today was an exception. In other words, yields were a bit higher until a few minutes after the day's last Treasury auction, but then began to fall almost all the way back to unchanged. Even if they hadn't fallen, today's trading would leave the bond market in fine shape to digest Tuesday's CPI data, one of the week's two big ticket items. The stakes are high, but the reaction function is simple. Higher, lower inflation is higher, lower rates. Pretty simple. UMBS closed the day down 11 basis points on the 6% coupon. The 6.5 was down 5 basis points. Looking at the 6%, we end the day at 100.61. So at 100.61, it puts us up here in this upper range. So we have the 200-day moving average and a Fibonacci below us, about 20 basis points below. And then a ceiling of a Fibonacci like a half point higher. We also got news over the weekend. A Housing Wire yesterday had an article addressing a claim that Wall Street investors have bought 44% of homes this year. The Medium article that was published last week led to a lot of activity on social media, and Congress even jumped on the bandwagon. The facts, as confirmed by Freddie Mac data, show that institutional investors represent about 2.5% of the market share. They do note that the overall 30% share of investors has grown since 2000, but that is mostly made up of mom and pop investors.